InvestSMART separately managed account benefit number 3. Total transparency. In a separately managed account, you'll see all holdings, transactions, and income. Unlike a managed fund where you'll only be shown the top 10 holdings, or sometimes even less. You get to see the successes, and we won't hide the losers. With a simple click on the stock code, you can read the logic behind every buy and sell decision. For more information, visit www.investsmart.com.au or download our new app.
Hi, I'm Daquino. I'm a journalist at Eureka Report. Welcome to Market Watch. As we gear up to the end of financial year, tax selling comes into the equation. But according to Australia's biggest broker, CommSec, the old adage, sell in May, isn't really holding up. In this period generally known for tax selling, when retail investors crystallise their losses to offset capital gains, tax liabilities, it seems that many are sitting tight. I spoke to CommSec Executive General Manager Paul Rayson this week, and he told me that his firm's retail trading volumes are down about 15% since the middle of May. CommSec is a good market barometer because it has just under 45% market share of Australia's online trading sector. Investors are voicing their struggles to find value. And then there's geopolitical concerns, which is translating into what Rayson described as subdued trading. But if we look at this table from the ASX showing trading volumes, it actually looks like volumes between April and May picked up sharply. So are we likely to see another spike through June? It is too early to tell, but some investors might be inclined to sell out of their poorest performing stocks to offset capital gains made elsewhere. It's a well-worn tax path, but taking a loss is never pleasant, and such a strategy needs to be well considered, not the least because the stock you plan to sell may actually rebound. And don't sell out of a losing position in the lead up to June 30 with the intention of buying back on Monday, July 3. That's called a wash sale, and the ATO hates it. So end of financial year means tax time, and it also means sales. And the sales signs are appearing earlier than previous years. Like investors, consumers seem to be struggling to find value too. However, our listed retailers were actually a very mixed bag for the first half of the year. Looking across 40 Australian retailers, investment bank Citi determined food retailing reflected fortunes of shifting market share. Soft goods retailers were set back, and hard goods retailers powered forward. Citi revealed that store growth slowed across the board though. Less than half of the listed retailers that Citi reviewed reported store growth over 3% in the first half. Compare this to 2/3 that reported this for the same period last year. Here's a chart showing which companies grew their footprint at less than 3%. As you can see, most of the heavyweights. Meanwhile, Morgan Stanley went as far to change its tune on the entire consumer industry last week, downgrading its view from in line to cautious. There could still be silver linings at the seams though. Although Deutsche Bank thinks it's largely a resources story that boosted consumer sentiment as of late, we have seen a boost in retail sales for the past month. Intelligent investor analysts are keeping a keen eye on the sector for opportunity as well, where specialty retailers have dropped between 20 to 30% in their share price in recent months. As James Greenhalgh, a senior analyst at Intelligent Investor, noted in an article earlier this week, it is a tough industry, and for every success story like JB Hi-Fi, there's a Dick Smith just around the corner.